Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 4 strong buy dividend stocks for January. So let's get into it. Alright guys, welcome back. Thank you all so much for being here and welcome to 2025. I hope you all had a fantastic holiday season. Today we're taking a look at 4 strong buy dividend stocks for January, and I do apologize this video is coming out a couple days later than I normally would, but I got to spend the holidays up in Canada visiting some family. Just got back into town yesterday, so now we're going to get back to our regular scheduling. So today we're going to take a look at 4 dividend paying stocks, all rated a strong buy and all with an ex-dividend date in the month of January. That is the date that you must own a stock before in order to be eligible for their next dividend payment. So with those coming up soon, it means you're not going to have to wait long to start collecting that passive income. Just before we get into these stocks, this is a friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can also download the TipRanks mobile app on your Android or Apple device by heading on over to the App Store or scanning the QR code on your screen down below. Now let's get right into our 3 strong buy dividend stocks. We found today's companies using the TipRanks dividend calendar. Found right at the bottom of the dividend menu, the dividend calendar will show you week by week all of the companies that have ex-dividend dates coming up. With the list down below, we can then narrow it by different filters. I selected the strong buy analyst consensus to narrow down our options. And for our first dividend stock, we're looking at OPRA. They trade under the ticker OPRA, currently priced at $19.40, having climbed about 58% in the past year and gaining 48% in the last 6 months. OPRA is a multinational technology company primarily known for developing web browsers and related services. They cater to a broad user base across Asia, Africa, and Europe with 296 million total monthly active users. And they offer a range of web browsers for both desktop and mobile devices with their Opera browser, Mini, GX, and Touch. They also have their Opera News Hub, which is an AI-driven news app, and their Opera Ads that allows marketers to reach their vast user base. They even offer free VPN, ad blocker, and flow file sharing. The company is fairly new to paying a dividend and does so on a semi-annual basis. And their current semi-annual dividend is 40 cents per share for a dividend yield of about 4%. Their ex-dividend date is January 6th for payment on January 13th. They shared their Q3 earnings report back on October 29th, coming out with mixed results with a very slight miss on earnings, but a revenue beat, and the company also once again increased their future outlook. They reported Q3 earnings per share of 20 cents, falling 1 cent short of analyst expectations, while revenue grew 20% year over year to $123 million, beating estimates by $2.77 million. The company raised both their revenue and adjusted EBITDA full-year guidance, now at a 19% year-over-year growth at the midpoint. And following that earnings report, we did have a few 5-star analysts increase their price targets, including one from Lake Street. They said they see momentum continuing into Q4 as heightened ad spending around the election and general demand remains strong, and they were updating their model to incorporate the Q3 beat and elevated guidance. And with 5 current analyst ratings, the OPRA stock does come in as a unanimous strong buy. The average price target comes in at $24.40, implying an upside potential of over 25%. Looking at those ratings down below, on the low end we have 3 price targets all at $23 for an upside of 18%, while our high-end price target is the most recent here from TD Cowen at $28 for an upside of 44%. Number 2 on our list is AT&T. They trade under the ticker T, currently priced at $22.81, having climbed 41% over the past year and are up 24% in the last 6 months. AT&T is a multinational telecommunications, media, and technology conglomerate. Their core services include broadband and internet as one of the largest providers of broadband internet services in the United States. They also have their AT&T Fiber, well known for their high-speed, reliable internet. Their telecommunications has their mobile services, and they also have television as well. Their business solutions also include enterprise services, and they offer a wide range of services for businesses, including cloud, cybersecurity, and hosting. For a long time, AT&T was well known as a high-yield dividend stock. Then a few years ago, they did a spin-off of their Warner Media business, and with that had a cut to their dividend. But even still, they have a very attractive yield. Their current quarterly dividend comes in at about 28 cents per share for a dividend yield of 4.87%, well above the sector average of under 2%. Their ex-dividend date is January 10th for payment on February 3rd. Their third quarter earnings report came out on October 23rd, also seeing some mixed results. They had an earnings beat but a slight miss on revenue. They reported Q3 earnings per share of 60 cents, beating estimates by 3 cents per share, while revenue came in at $30.2 billion, which did miss by $250 million. The company did see 403,000 postpaid phone net adds during the quarter. Just a couple of weeks ago, in mid-December, a 5-star analyst from Morgan Stanley upgraded their rating on the AT&T stock to a buy and named it their top pick in the sector. They bumped up their price target to $28 from $19, calling it their top pick among the North American telecom and cable services group. They see growth driving outperformance led by product leadership in fiber at AT&T. With 17 current analyst ratings, AT&T comes in as a strong buy based on 17 buys and 3 holds. The average price target comes in at $26.75, implying an upside potential of 17%. Looking at those ratings down below, our low-end price target is back at the start of December, a hold rating at $21 for a downside of 7%, while our high-end price target is a more recent rating here from UBS at $30 for an upside of 31.5%. For our third dividend stock, we're taking a look at Zoetis. They trade under the ticker ZTS, currently priced at $162. This stock is in the red over the past year, down over 15%. Zoetis is the world's largest animal health company. They are the largest manufacturer of medicine and vaccination for both pets and livestock in the United States and internationally. They offer a wide range of products, including parasiticides, anti-infectives, dermatology products, and pain management, as well as vaccines, antibiotics, and growth promoters. They also offer diagnostic tools for veterinarians, including point-of-care lab services and genetic testing. Now, Zoetis does not have our highest yield of the group today, but they do have an impressive dividend growth rate. Over the last 10 years, their compound annual growth rate for that dividend is over 20%. And they recently increased that dividend by 16%, bumping it up to 50 cents per share. Their ex-dividend date is Tuesday, January 21st, for payment on March 4th, and that dividend gives them a yield of about 1%. On November 4th, they shared a Q3 earnings and revenue beat and increased their full-year revenue guidance. Their Q3 earnings per share came in at $1.58, beating estimates by 12 cents per share, while revenue grew 11% year over year to $2.4 billion, beating by $110 million. The company raised their full-year revenue guidance to $9.2 to $9.3 billion, representing growth of 10 to 11%. Recently, reiterating a buy rating on the stock was an analyst from Leerink. They noted that Zoetis has been one of the best performing names in animal health from a growth perspective, with a core competency of identifying new market opportunities and successfully executing against them. This has led to the company growing its top line and earnings per share at a rate above the broader space. With 9 current analyst ratings, the stock does come in as a strong buy, with 8 buy ratings and 1 hold. And the average price target of $211 implies an upside potential of 29%. Looking at those ratings down below, on the low end, we do have our hold rating here at 196 for an upside of 20%, while our high-end price target comes in at 248 for an upside potential of over 52%. And if you've made it all the way to our 4th stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least, we're taking a look at Dell Technologies. They trade under the ticker DELL, currently priced just shy of $120. Their stock has gained 60% over the past year and is down 13% in the last 6 months. Dell is a multinational tech company providing a range of IT hardware, software, and services. They aim to be a one-stop shop for enterprise IT solutions, providing an integrated approach that includes hardware, software, and services to help businesses manage, protect, and transform their IT infrastructure. They are renowned for their personal computers, including the XPS, Vostro, and Latitude series, and they also offer a range of server products under the PowerEdge brand. Dell Technologies is another company that is fairly new at paying out a dividend. Starting just a few years ago, their quarterly dividend now sits at about 44 cents per share for a dividend yield of 1.45%. Their ex-dividend date is January 22nd for a payment of January 31st. And they shared their third quarter report on November 26th. This is another one with mixed results, having an earnings beat but a revenue miss. For their third quarter, they reported earnings per share of $2.15, beating estimates by 9 cents per share. Revenue did grow 10% year over year to $24.4 billion, but did miss by $350 million. Their infrastructure solutions group did see their revenue grow 34% year over year. Following that earnings report, an analyst from Deutsche Bank did slightly lower their price target by $2, but reiterated a buy rating. They noted the company's double-digit pullback following the results as a buying opportunity, given their view that the fundamental catalysts across the business remain intact and are more deferred than anything. Dell is rated a strong buy based on 16 analyst ratings with 14 buys and 2 holds. The average price target comes in just shy of $150, implying an upside potential of 25%. Looking at those recent ratings down below, a lot of them in the double digits recently, but our low-end price target is this hold from back in November with a downside of 4%, while our high-end price target is $185 for an upside of 54%. So that is a quick look at 4 strong buy dividend stocks, all with ex-dividend dates in the month of January. Let me know what you think of these companies in the comments down below and what other dividend stocks have been catching your eye lately. You guys know I always appreciate hearing from you, even if half of you think I'm AI. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are looking at, so please make sure you always do your own research and due diligence. Thank you guys so much for watching, Happy New Year, and I'll see you back here next time.